Hello, passive investors. Welcome to Passive Pockets, presented by Equity Trust. I'm your host, Jim Pfeiffer. A critical part of investing is knowing who you're investing in. So today, we're going to meet an operator. This is Anthony Morena from Mortar Group. Anthony, thanks for joining us.
Thank you for having me. Appreciate it.
So we're going to start with just some basic questions. And again, this is to allow the community to get to know you as a person, so then they can make the decision whether they want to invest with you as an operator. So a couple personal questions. Where did you grow up and where do you live now?
Grew up in New York. And now I live in northern New Jersey. My wife is from up here. So after we had kids, we kind of
got out of town.
Yeah. But Mortar is still New York based. So I'm back and forth between the suburbs and Brooklyn and Manhattan 5 days a week for the most part.
Awesome. And what do you like to do in your free time? Hobbies, activities, family stuff?
You know, it's tricky. I got 3 kids, 15, 13, and 11. So it's a mix of baseball, volleyball, and basketball right about now. But, you know, I run. Basically, if I get a free chance, I'll run. I'll try to bike a bit, get outside.
And chase your kids around and be a chauffeur probably, right?
Chauffeur is my number one job this year by far. It's not even close.
I get that. So let's talk about real estate a little bit. How did you first get into real estate?
I started off in architecture. I went to architecture school, became a licensed architect in New York. And then very early on in my career, I kind of realized this wasn't for me, but I liked the idea of architecture, but I liked development. And I had started to tinker with it with classes in college. And a couple of years after architecture school, I started my first project while I was working at an architecture firm. So it was basically weekends and nights. I started my first development project. I thought I knew what I was doing, did not know. It took twice as long. It turned out well at the end, but it was a quick way to kind of learn the process. That was kind of my first intro into real estate. After architecture school, while I was doing this, I went to NYU in New York for real estate to try to get more accustomed to the field and how things work. Then I went to work for a developer in Midtown Manhattan and went from doing kind of, small architecture work to doing 500 unit towers in Midtown, and did that for a few years, which was great because you got to see things from an owner's side. So then after kind of doing all that, what I wanted to do was kind of create a company where I could still do architecture, still do design stuff, but focus mostly on the development, with the idea of kind of bringing everything in together, consolidate it to make it more efficient. And that was kind of my start and kind of where things started to go from, early on.
Excellent. And so we're going to talk about a good deal, but think about first one of the worst deals, or something that, a deal that didn't quite pan out. I know we've all had them. What was the biggest factor in the, failure or the difficulty that you had, and what did you learn from it, if you can think about that?
Sure. So, the way we do things, we do basically 2 types of projects. We do your more traditional value add stuff, and then we do ground up construction for condo development. Ground up is a riskier proposition. It's got the higher IRRs that everyone likes and is, it's alluring in that respect, but it's a riskier proposition. But we've done a ton of them. Most of the time they've gone well. We've had deals that we've done during the Lehman crash, but the one that we probably did not go the best was during COVID. We had a project in Midtown. It was a 10-unit construction project. We finished the project on time, on budget, but the project started in 2018 when comps in Midtown Manhattan were, $1,700 or $1,800 a foot, which for Manhattan, that's kind of, where the market was. And we had planned to sell out at around $1,600. We were trying to be a little bit below and just, a boutique project. But after COVID and we went to market in 2020, the market there was $1,300 a foot. It was dead. And it stayed that way probably for 2 years. So it was the increase in the debt cost. While construction and everything else was on budget, the project turned out really well. It's just no one was shopping for Midtown Manhattan.
The market changed.
Yeah. And even though it did turn around and now it's doing well, we didn't have that timeline with the construction project to kind of wait it out. That was the one that kind of killed us the most. And we've kind of done reviews to see, what could we have done better here and there. But it's really hard to pick and find out just because it was really an issue of pricing and just an unforeseen event like COVID.
Right. Well, let's pivot to think about one of the best deals you've ever done, and what was, the biggest factor that contributed to the success of that deal.
Whenever you start a project, you're always optimistic. You can never time the market. You try to take educated guesses. Anyone that says they can time it, it's either you're lucky or you're not sometimes. But for us, it's like finish quickly has been the key. If you can finish quickly and get sales going for your exit well in advance of what you're initially planning. That's usually a good starting point. And just be conservative. When I was 25 and trying to do my first deal, I wanted a home run. I wanted to kill it every single time. I'm well past that phase. You try to hit doubles. You try to do doubles. Sometimes they turn into triples, and you just try to be consistent. That's basically the key to it. In doing it that way, it's been successful. It's been a slow growth where it's just like do one deal, finish, do another one, get better and better, make some changes with each project. As each real estate cycle, you learn little things, and the market changes, you adapt to it. And I think that's kind of really the key to it, adapting.
Yeah, I agree. I've always thought of real estate. It's not a get rich quick scheme. It's a build wealth slowly scheme. And I think you kind of nailed it. So on that line, Passive Pockets were about helping people figure out how to build financial freedom, whatever that means to them in the way, through real estate. So what does financial freedom mean to you?
It's a couple of things. One of it's, the passive income is always one of the things. That's what got me into the business. The idea that supplementing revenue at the time from architecture was kind of the goal. And then it kind of built from there. So it's that, and it's, having some freedom and control over your own decisions other than your standard job or, things like that. And diversifying, mutual funds and your Vanguard mutual fund are the key to the game, but spreading things out and trying different things is a good way to kind of hedge your bets against different alternative investments and really kind of build slowly. To your point, it's the turtle always wins the race. It's just a slow growth, and compounding. For us, it's a 3-year deal. We've had investors that have worked with us from the very beginning, and then people that are new with us. And it's like, sometimes people roll a deal into, one deal to the next. And it's like this slow growth where you start with $100 and it goes to $120 and then $150. And it's just like this slow thing. And then when you're done, it's like, hey, we did something pretty cool here. And it's something, that people tend to, really enjoy.
Okay. So last question. What is, in your view, the most important thing that passive investors into syndication should learn or do to maximize their success in this type of investing?
I think the first thing is just do your homework. Know what you're getting into. Real estate, once you get the general handle of it, is pretty straightforward. There's a language, there's a process to doing different projects. But I think once you get well versed and you understand how deals work and how sponsors are presenting something, I think that's really the key. What kind of deals are they doing? How long is the term? Where are fees being charged? Every sponsor needs a fee to keep an office operating. If there's no fee, I don't know who the hell's running the job. It takes people. But there's different levels to that. So that's a big thing to understand. And then understanding track record from a sponsor, and liquidity. Liquidity has been the key. When the market goes south, it's the sponsor's liquidity that does it. For us, when there's a project shortfall, you can't always go to an investor, hey, we need, the sponsor has to be able to cover those things. And if they don't, things go into default and people can lose their money and their investments. So that's really it, and then just working with people to really try to protect equity. You shoot for the objectives, but sometimes you have to pivot and work your way through a deal. We had deals like in 2020, 21 when we bought them at 4%, interest, and we've got our rates locked. But if you were in contract to something in 21 and you went to close in 22, your rate was significantly higher and the numbers change. So you just got to be careful with how you look at them.
Excellent. Well, Anthony, thank you very much. This wraps up our operator interview. Thank you for coming on, Anthony. We appreciate it.
Thank you. Appreciate it.